All right. Well, good afternoon, investors. Welcome to our January 13th edition of Bull Sessions. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and I'm joined here by my dear, gifted mathematician friend from mid-Michigan, Ken Kavula. Good afternoon, Ken.
Hello, everybody. Hello, hello, hello.
Kim Butcher's not able to join us as she's taking some friends to the airport, but Matt Spielman's here. Good afternoon, Matt.
Good afternoon.
And Matt was the one attacking all the wonderful sayings and Americanisms and stuff a few minutes ago, and I completely agree, Matt. The jargon in the finance field and investing is rampant, and one of Kurt's missions, we're also joined here by Kurt Kowitz. Good afternoon, Kurt.
Hello.
Kurt is constantly saying, what does that mean and why do we care? And this is kind of the answer to your question a few minutes ago, Ken. I'll go to something and something that just appears. And what it will be is, I just happened to mention to Kurt a few weeks ago, it'd be kind of cool if we could do something like this. And then he doesn't tell me, it just shows up. So I'm not going to complain about that. It's really cool. So thank you, guys.
And sometimes we all together within a 2-hour period discover that creating something new or fixing something in one part makes something in the other part not do what it used to do. So it's still a work in progress, but it's mostly there for you to help us make better.
Yeah, and in that spirit, I mean, there are going to be things that will be disrupted. They get fixed. They get fixed fairly rapidly. We are answering emails and text messages and phone calls continuously. But it is an evolution, and it's a wonderful thing to watch this type of software development. I just think it's wonderful. There will be times when you get slightly frustrated or whatever. We're going through some stuff right now with clubs and making sure that stuff is all streamlined. There will be changes and a variety of things. Another thing that we should talk about just a tiny bit here. We've discovered that the public dashboard thing isn't being used as intended by a few people, and we have to figure out what we're doing about that. So some of the public dashboards have been suppressed, and we'll basically be going back and figuring out which ones we can keep as public, but bear with us on that type of thing. So we will be going through a few things like that. Any other questions or comments?
Well, Mark, I think you should make the comment that you made to just me when we first started our own private session about 35 or 40 minutes ago about we'd rather see you help us develop this thing and make it better with all the warts in the beginning stage rather than have us promise to give it to you a year from now in a completely polished stage.
Absolutely, and Kurt's very receptive to doing this.
Yeah, being the one to blame, I'll just jump in and I apologize if my approach is perhaps rash, but after 20 years in the industry and developing websites, sort of the consensus is if you want to get things done, if you want to make improvements, you do them in very quick sprints, which means code for as long as it takes to get the feature out, add some tests to make sure you think it's doing what you're doing right, and then you deploy it. And you let your customers tell you if they like it or if they don't like it. So if enough of you tell me you don't like something, I'll take it away. And if somebody says, boy, that's nice, but I'd like it to do even more, I'll make it do more. And it'll be there quick. And until we decide we're done, I'll probably keep operating that way. Unless Mark says, Kurt, you're just too disruptive. We got to slow down. In which case, I'll slow down.
We'll know, for example, we're going to meet later about the worksheets. The worksheets are not perfect yet. Kurt knows that. They don't always sort the same way, for example, but we'll get that fixed. So just trust him, and I have a lot of trust that we'll get where we want to be ultimately. So
there is one more thing. There is some quick and easy additions to the feedback. You can contact us directly through the widget for a bug, and there's a combination widget for just sending us an email. So either one works. You'll probably get to either Mark or I. We'll get back to you as soon as we can. So thanks.
All right, so we are going to cover Buttonwood today. We're not going to cover the website too much just because we won't have time, but that we will dedicate more about the website development next week, focusing on finding ideas and the most important stuff that we do here at Manifest. You guys will probably all recognize the monkeys and the goat on the left. It's all over the national news. They escaped from the St. Louis Zoo, so they're running around in the streets of St. Louis. So much like we always do here at Bull Sessions, that's just there as a date stamp. Those guys are literally running around.
It's kind of humorous, Mark, when you're watching the real serious news and you're seeing big warnings about don't approach the monkeys. They're not as friendly as they look. So
I first thought it was some kind of hoax, and then it started showing up in all kinds of news outlets and that kind of stuff. So we're going to basically focus on Buttonwood quite a bit. We do have a couple other things to share. The current update does include a bunch of retailers. In the current edition of the Value Line Investment Survey update, and that is a work in progress. I will probably finish that later today, so we'll be out with a fresh new set of data. We are catching up fairly rapidly as we make that transition, and I'm not getting any sleep, but we'll get by that someday. But I really do like this quote from one of the founders of Intel, because I really do think that we are a relatively small community of people, and I do think we know what we're doing. We literally lean on 7 or 8 decades of investment club experience. We lean a lot on the preferred procedure. Sorry, Kurt. No, we lean on recognizing that the most important things about any investment are the return forecast and the quality of the company. That is the most important stuff, and anything which contributes to that is also important. But as we'll look at here in a few minutes, the groundhog, you're basically talking about the groundhog challenge. You're talking about 210 people achieving an average return of 24%. And most of them are not swinging for home runs. They are continuing to attempt to select high quality companies at good prices. And it's just amazing to watch. So Ken, do you want to preach it all about this, or are you good?
well, before I do any preaching, and I don't especially want to preach about that topic, I'm getting texts from 2 different people telling me that all they're seeing is a blank screen. These came to me on my phone as a text, and we're not seeing that from anybody live to those 2 people that shouted out to me. One of them is from the B.I. Baker Model Club. So we're meeting this evening, and so she was here to listen. But I don't know what to recommend, but we're not seeing that as a uniform problem unless somebody can put that in the question box that you're not seeing any of the slides either.
I'm checking the view output, and it looks okay to me.
Okay.
I would highly suggest stopping GoToWebinar completely and joining again if that's the case. It's probably a case where it's not picking up the video feed.
Could be just a frozen.
Okay.
Frozen in.
Yeah. And that was Kurt, and he knows more than all the rest of us combined about tech. So listen to what he said, and I'm getting a lot of people on the site right now saying that they can all see the broadcast and see the slides. So
okay.
I don't want to mention the names of the people that are having problem, but you 2 know who you are. So Kurt's suggestion is to leave and come back. Okay.
And if that fails, we'll reaffirm this later on, but we do record this, and it will be available via YouTube after the session. So if you get shut out for some reason, and the copies of the slides also.
And I just got a text from one of the 2 people, and she indicates it worked. So we're all set. Okay.
Okay. All right. Our quick Portillo's moment. Ken, did you notice that increase in price on the lower?
I noticed. What's that? A 15% increase in. I mean, the numbers are really small, but you're moving back towards your basis here pretty quickly, huh?
Yeah, I actually bought a few more shares at $4.50. So I may be profitable someday soon.
77 cents on a $4 stock. That's pretty decent, you know?
Yeah, signs of life. And I think showing my age here, but I can remember when this episode came out on ABC of Batman, and just an important day.
I can remember my father's comment when he first saw this on television, so I'm not going to give it to you.
Is it not suitable for this audience?
It wasn't suitable for me or my brother at the age we were, let alone for our audience, so we're going to leave it.
All right, moving on. No investment recommendation is intended. That's always true here. This is all about education and demonstration of the philosophy, methods, and techniques of the modern investment club movement. Do your own homework, make your own decisions. We aren't your boss. That when it comes to investments or investment-related resources. If you'd like copies of the slides, if you have questions, or if you have suggestions for future topics, let either one of us know. Anything else, Ken?
I keep getting questions from newer folks, Mark, especially in the clubs that I belong to, is what's up with this idea of groundhogs, okay? So
We'll cover that.
Groundhog Day is fast approaching. That's February 2nd, and we'll be starting a new groundhog contest. And the groundhog itself is the mascot because Manifest was launched on Groundhog's Day. How many years ago, Mark?
It will be 21 years ago here in a month. Well, 3 weeks.
Right.
So good stuff. Speaking of the Groundhog Challenge, this is the contest. If you're new to this, if you're new in the audience, we basically challenge our community to select a minimum of 5 stocks, as many as 20, but you'll do better with 5 in general. And the contest runs from Groundhog Day to Groundhog Day. We've done it for 19 years. And this is kind of what I was getting at earlier. The average return is up to 24.4%. I mean, that is actually pretty spectacular, at least in my opinion.
Well, I think it's wonderful that I can be in 28th place, Mark, and only return 49.9%. So,
I mean, this 24.4 is pretty special. It's good stuff. And you can see that it's been on the uptick. 3 out of 5 participating groundhogs are beating the market. The market, as we measured by the Wilshire 5000, is actually at about 16%. So it's been a good year. You see the S&P has checked in at about that over the trailing year. Fascinating. We're going to talk a little bit more about this. The value line arithmetic average, which we talk about as a market representation, 12%. And Ken lives in fear of the monkey, the dart tossing monkey, and the monkey is almost in last place this year. So that gives him great comfort. We do have a new leader, Nikki. I think it's Patrika, and she's got a fairly decent lead going into the last 2 or 3 weeks of the Groundhog Challenge. So good luck to Nikki. And there's a whole bunch of people that have been hovering in those top 12 positions that are there to challenge her. And we have seen a few clubs drop off the chart. There's a bunch of them just south of 50. But again, we don't want to call out too many people. Kurt's on the list at 40, though, with his 5 minutes
Mark,
of effort.
Am I remembering that this is probably the highest potential finish for a club in the last 4 or 5 years? I don't think we've had a club in the top 3 or 4 in that time period, have we?
No, the motivated investors are in kind of rare air. And
I will tell you, they have been talking to me in the last couple of weeks. I'm still looking for their portfolio for the Jamboree, and I've saved them a spot in the Jamboree.
Good.
But, you know, if we don't look at their actual portfolio, maybe we'll look at their groundhog portfolio, because it's certainly a wonderful return for 11 plus months at 81%. So
yeah. Are they bashful, or they
I don't think they're bashful. I think they're still out there earning or paying Social Security, so the rest of us retirees can lounge around. You know.
Oh, good. I'm in favor of that.
Right.
I was on the phone with Golden West this morning. They're doing well, and they're certainly in contention along with they're both repeat champions, and Bower City Ladies, 3-time champions. They are still in the running. Anything can happen in 2 weeks. And a couple former champions at the top of that list. And Ken, you're still on this list, right? Oh yeah, you're still.
Oh, I certainly am. I moved up from last week, so I'm feeling very, very good about this whole thing. This 50% return that I have right now is going to really boost my average on that chart you show after the contest ends all the time. You know, what we've been doing every time since our first entry into the contest. So yeah. I'm looking forward to it.
If you edge me out on the 19-year average, I may have to do some recalculations.
I know that happens all the time, so I'm well aware.
But anyhow, a lot of good friends on this list, and congratulations on being up there. If you're not, give it another try. And it can be a humbling thing. I think I am down around 58th or so. I did want to mention the club, the Four Corners Investment Club, because they are down in that mid-50s area, just off the list. But the Fritzes and Keith Tubbs, and there's a number of partners within that club, and they are on the list, so I just thought I would call them out. All right, so let's go ahead and press on. Good luck to everybody here in the last couple of weeks, and let's have some fun. All right, here's just a quick look at, we talk a lot about 10%, 11% return. So Ken, I thought we would share just a couple quick statistics on why we do this, how we do this, and just a reminder of what investing looks like over time. And of course, the slide on the upper left makes the case for investing in stocks. We know that. And what I found kind of interesting, this is presented by Ben Carlson at Ritholtz. Found kind of interesting, how nasty that flat decade was, the lost decade, or what do we call the first?
It was called the lost decade, yeah.
Lost decade. That's what's showing up right here. Okay, and anybody who lived through it, it was rough. It's actually what you see right here. This was the big cause of the problem in the middle of that value line chart. But what I found kind of interesting here, Ken, is I refuse to go back and use any statistics before 1940. So if we toss out the 1930s, you actually get this number, which is kind of cool. And then 40 years with the value line arithmetic index checks in at about 10%. So again, it's just kind of resonating with those numbers that you hear Ken toss around all the time. Anything else you want to share here, sir?
Well, yeah, what I want to share also is the extreme cyclicality of gold. If you have friends that are gold bugs and that are urging you right now to jump into investing in gold, just keep in mind that history shows that there are occasional really great surges in the price of gold, but it's probably not going to pad your nest egg as much as you thought over long periods of time.
Yeah, it's certainly a current rage with all the geopolitical stuff and everything else. And there's the real inflation numbers, not the ones you hear talked about on the nightly news.
I will tell you that I have two former students in my private investment club. They've been in the club for 30, 35 years. And one of them I taught calculus to. And I can remember him understanding that I was really interested in investing. And at the same time, he was buying gold as a high school student back in the late 70s. Mm-hmm. And he made a nice pile for about 4 months. And then you can see what happened in the 80s and the 90s. So beware.
Yep. Stocks are different. They're just simply different. And Ken, here's your chart.
I love this chart. Yep. I don't think we've had a stretch as consistent as 23, 24, and 25 for a long time, have we? I'm looking down that column and I don't see a whole lot of triple hitters. In fact, I don't see any triple hitters on that column. I see it in the 0 to 10 in the early 90s. Yeah.
Yeah, and back in the late 90s, there was a pretty good run for a few years. But yeah, this is as good as it's been for a while. So I mean, we're going to get a speed bump at some point. We should.
One of the charts I like even better, Mark, is where you show either 3-year returns or 5-year returns. I think you have a kind of a version of that coming up in the slide deck here. And when you look for a little bit longer periods of time than 1 year, the number of 3-year periods or 5-year periods begins to take that red off the chart completely then.
Yeah, and over here we see those single years with negative returns, right? And that's what Ken is saying. This chart here shows, well, what if you put them together in 4-year periods? And what you basically end up with is just one time in the last many, many years. I didn't go back before 1985, but that 2008 moment was special. We'll call it special for lack of a better word, keeping it PG-13. But that 4-year period was ugly, and it actually did discourage a lot of investors. But you could see that the 4-year performance is, again, here's that 10 or 11% number. You can kind of eyeball it right down the middle. And then what you also see is what we've talked about here for the last couple of years. This 4-year total return from the value line arithmetic average has been slumping a bit below historical levels. And that continues to suggest outsized opportunities in the smaller and medium-sized companies. We still believe that.
Yeah, what we're looking at when you make that arrow right there, Mark, is the putting together of so much of the stock market's assets into 7 or 8 or 10 stocks. And if you're not part of that, if you're part of the other part of the market, the 5,000 minus 10, then it's been a little bit rougher, and that's what we're kind of looking at in the graph right here.
And that makes the performance of the groundhogs in the Groundhog Challenge all that more compelling when you think about it.
If you remember, we've also been using a chart in a lot of our teaching when we visit chapters throughout the country. We have a chart that shows that for even longer holding periods than 4 years, the probability of being in a maybe a 6 or 7 or 8 year holding period and having a negative return almost vanishes. It goes up to a probability of making money with a 99% or better chance to have that happen as the holding periods become longer. So if you stay true to yourself over a typical working career, you have a pretty good shot of entering that retirement after the working career with a nest egg.
Absolutely. All right, here's our current day look at the market. While we spend so much time thinking about what return can we expect, what is the return forecast for the stocks that we study and or are stewards in ownership of, the green bars are simply the stock market as represented by that value line arithmetic average. And the dots, they fluctuate. They fluctuate with prices and with operating conditions. So they move around a bit. And you can see that they're all checking in right in that high single-digit area right now. Then I don't know if the sample size is any good at the bottom, but we started off the year pretty good. Many of the times that the first 5 trading days have been that good, the average gain for the year has been pretty good. It's really a good time to get out there and find really good companies at good prices.
The only thing that I don't like about quotes like this one at the bottom, I think it's interesting. I think it's a curiosity, but I think we need to remind ourselves that even though 80% chances of it happening again is a nice thing to talk about in very highbrow misunderstanding of statistics, it's not by any means a slam dunk.
Oh, no.
And you should keep that in mind. Yeah.
No. And as a quick reminder, there's red ones on here too.
Yeah.
All right. So with that, here's a quick look at performance perspectives. I did want to focus in on that value line arithmetic average a little bit, just to give a little bit longer term context. You can see that over the last 10 years, it has underperformed over the last, I don't know how many years. That's going back to 1988. So that's 45 years, 47 years, something like that. 37, 37, 40.
25, 35, 37. Yeah.
So there, the value line arithmetic average, again, that blend of small, medium, and large companies has beaten the market by 2.3%. So I'm talking about this right here. Just the fact that investing in, just like we always say, all of the above, you should be investing in large, medium, and small companies in your personal and or club portfolios. The 10 companies that show up on this list are the 10 most widely followed by our community, and some of those have done pretty well. Tin Cup is a demonstration portfolio. It's a 401k simulation at Manifest. That's done pretty well over the years. And we just love the round table. That's our monthly gathering of friends. And we have top 2% again. Hopefully that'll head back in the right direction. Thanks to our Ardelyx, Ken. We'll help them now.
Mark, I'm going to have to be away from the program for a couple of minutes here. Okay. I have an important phone call. And Matt, can you take over what the things I normally do? Thank you.
Oh, all right. Big shoes to fill. I'll try.
All right. Well, one of the things we will be talking about here, Matt, is the Buttonwood. If you've been following us for the last couple of years, this portfolio started January 2 years ago. And it would it be fair to say that it had a slow start, Matt? You be kind.
That's a charitable way, yeah. I think that's fine. You have so many demonstration portfolios, and I think we like to say the power of the method is shown by how many do so well. But I think it's okay, maybe not preferable to those doing it, but it's okay to have one stumble and see how you get out of that rut. I think that's a common situation for people. That's useful to be a demonstration too.
Yeah, I mean, there many investment clubs form at an inopportune time, and you can't get discouraged. You just have to put your head down and keep doing it. Ken and I have certainly done that with Buttonwood, and it's you can see how hot, this is what we're trying to keep up with over the last 2 years. That's a huge number, but the fact that this has snuck back into a very respectable range, I think we're in pretty good standing.
And the fact that you've stuck to it, you haven't changed the rules. You're still shooting for the same thing. The rhinos, the professional fund management industry, is often accused of some selective pruning or selective history. When they give history of their funds, you have to remember it's always the funds that still exist as they close down underperforming funds and sort of keep the people who happen to historically be winners. And you're not doing that.
At least not yet. Ken's talked me out of it a few times. So
yeah, Bill Warner says you told us to wait 5 years, so judgment's coming in another 4.
All right, so we'll keep pressing on. So here is a look at the Buttonwood performance over time. Again, it's a couple years old now, so we started tracking the actual assets in the blue. That's the Buttonwood balance. You can see that it's been on a pretty good trend. Even more importantly, the rate of return has now returned to very respectable levels. And we always want to keep that portfolio projected annual return, or PAR, in the, let's say, 12, 13, 15% range. So we'll be working on that here as we keep going. And again, right now, if we basically looked at the value of the portfolio, and if we were to achieve an approximate 12% return, we would be at $10,000 5 years from now. So again, it's just showing, what is reasonable to expect for doing something like this. So I think this is a very telling graph, and one that we probably will be using a form of quite a bit going forward. So 11.8%, we're thankful, and we will keep pressing on. All right, here is the portfolio as it currently stands. Has quite a bit of cash in it. And that's a pretty good chunk, so we will be looking to invest that, all of it today, as much as we can anyhow. When we take a look at a portfolio, and we'll be doing a form of this during the Jamboree, we basically focus in on, I would say, 3 core items. The first being, what is the return forecast of the portfolio? In this case, 11 to 12%. We'd like that to be a little bit higher, but it's still not bad. We'd love to see it get up into this 12 to 18% range, as you can see up at the top, but that's okay. Quality is good. Quality is basically, it's a stack of excellent companies with, we've allowed a couple good companies in there, but it's a good stack. And then the other one that Ken just completely is obsessed with for all the right reasons, we really want that number to be 12, 13, 14% on average. So it's in range. We want to continue to keep it bolstered. What do you like about the portfolio, Matt? What do you see? You own any of these?
I own a number of them. I do still hold Western Alliance, quite a significant portion. Of course, Green Brick Partners, still one of my favorite. Very interesting political situation it finds itself with housing in focus, and whether that's positive or negative, but I think they're one of the best operators. Google, I don't know, can we say Google my only $4 trillion company? Maybe, no, I guess it's not my only $4 trillion company. I have a couple. I have to have a couple. And a few that I have owned before. But I was just thinking as you were talking, look at Novo Nordisk and the reversal of fortunes, right? From having bought it sort of at the end of the initial GLP-1 to maybe thoughts that Lilly is winning, and some focus from the administration, and now a pill comes out and people are finding it again. And so if you look at its relative position in the we have bought it more than once, right? But look at the position 6 months ago in the portfolio, it's toward the bottom, and now it's toward the top. So that patience and understanding and belief in a company that's moving forward shows despite where it is on the chart today.
Yeah, and we have talked about how, if you're not familiar with the company, they do make one of the obesity medications, and they also make diabetic insulin. And so if you basically look at their field of opportunity, one, it's actually gotten a little bit better. If you read some of the statistical analysis of, we are losing some weight, and there's more work to be done, but they're going to be in business for a while. They've been in business for, I don't know, it's over 100 years, so it's not a new company. And I don't think that the landscape has changed that dramatically for them. They're always going to have competition, but I think it's a company that we can afford to be quite patient with. Some of the others, Ken loves United Therapeutics for the work they're doing and trying to solve some challenges with organ transplants and that sort of thing. And there's a number of companies on here. We're going to cover NICE more carefully, probably within the next month. About middle of the list there, NICE. Just wondering about the company. There's two schools of thought. I've gotten a number of emails from several of you in both camps. Are the wheels coming off, or are they not? Are they just facing challenges? But pretty good representation from top to bottom. We'll also be raking Gentex over the coals a little bit because it does have the lowest growth rate. It's not a low growth rate, but it's the lowest in this particular portfolio. And one last word, I'd be tempted to throw money at Visa with all the bantering that's going on with respect to putting limits on credit card companies. That's not going to happen, at least not in the way that's in the news over the last couple of days. So the prices are down. I don't think they're down with good reason or cause yet. That's a personal opinion. Is Ken back with us yet, or is he still detained? He must be.
Well, the mic's open, but I don't hear him.
Okay. All right, so let's go ahead and talk about some ideas for the portfolio. There are some companies in the portfolio that merit some consideration. We'll talk about that. But I wanted to take a look outside the portfolio for potential investment opportunities. This is the Sweet 16, and I tried out a new concept, something I've wanted to do for a while. Looking for companies that are, high quality, excellent companies, but have been beat up, oversold. And we're not chartists here by any stretch of the imagination, but we do tend to use the relative strength index, that RSI that you see there. Again, I apologize for the jargon. Sorry, Kurt. This is just something that the technicians use to identify prices that have really been hammered. And is that an idiomatic expression? I don't have to explain that, do I?
Can be, oh yes, constructed into useful shapes, right? Hammered.
There you go. Well, the relative strength index, anytime that gets down below 30, it's deemed to be potentially oversold. And that's what you'll hear, when the talking heads are on CNBC and they're talking about companies that are oversold, they're talking about these types of companies. Opposite end of the spectrum is when they're at the other end, a relative strength index greater than 70 or 80, then they're overbought. And either one of those two conditions can be used as perhaps a nudge into a buying or selling situation. Does that mean Ken is back with us?
Yeah, Ken is back with you.
Okay. So here's a list of the companies. One of the things I've always wanted to do is I don't necessarily care for absolute numbers like that 30. I would like to know, well, how does that rank versus all the companies out there? And that's what that relative RSI is. It's basically a percentile ranking. So now I know that Netflix is in the top 1% of all companies with respect to being oversold. So an oversold company with an excellent quality rating and a decent return forecast. And I did present it during the roundtable. The audience agreed with me, and Ken sort of agreed with me as we prepared for this. So I'm going to suggest that we perhaps add Netflix to the portfolio. Any dissent?
I think it's a wonderful idea, especially with the possibilities going forward of them picking up. What is it? It's Warner Brothers. No, it's Paramount, right?
Well, they're battling with Warner Brothers for
Paramount, right?
Yeah, Paramount is the jilted suitor.
Yeah,
right. Oh, Paramount's the jilted suitor. Anyway, they're battling for Warner Brothers, aren't they, Matt? Is that right?
Yep. Yeah.
Okay.
Warner
Anyway,
Discovery.
The only caution that I've read in anything that I've researched in the last couple of days, Mark, is that there might be some questioning movement from the regulators when it comes to a deal like that actually putting itself together and staying glued to each other if it does happen. But I'm willing to take the chance. I think Netflix is a wonderful company.
Yeah, I think they've been beat up. I mean, anytime you're into an acquisition like this, there's going to be skepticism. You're always going to have antitrust when you get this big. They're basically trying to acquire content and assets that are accretive to their own collection. So it strategically seems to make sense. So we'll go with that. Other companies on here, there's some pretty good companies on this list that might merit a run up the flagpole. I've always been kind of intrigued since your presentation on Waste Connections years ago, Ken, and they make this list again here.
Waste Connections, Mark, is one of those companies that never quite make the buy zone on a stock selection guide when I do it. It always comes close and never quite makes it. So that's a pretty decent par for it today. I didn't realize it was that high.
Yeah, might be worth taking a little bit closer look. And there's some others on here. Many of them are still affiliated with information technology or data centers. So here is basically what we want to talk about today. The proposal is going to be to buy 4 shares of Netflix. And then I'd like to add 2 more to the pile. And then we're starting with where we'll end up. And this is one of the tools that Kurt has put together with the worksheets. And they are a work in progress. Be patient. They're going to get to what they need to be. This is a pretty cool adaptation of what many investment clubs do. They take the worksheet and they prepare a proposal where they say, what if we did those 3 things? What do we get, between the current proposal, the current portfolio and the after portfolio? And you can see here, you're basically improving quality, you're improving the return forecast, and you're improving the growth rate. These are all things that Ken Kavula breaks out into a cold sweat over when you accomplish. So,
well, you can put an error on the 4th one as well, Mark.
Yep. So they're there. So that's what these 3 proposal concepts would do to the Buttonwood Bulls proposal. IES, we continue to like it. It's not a screaming buy, but why not round out to a single share? and then we'll take a look at Adobe also. I think that's a pretty good opportunity also by itself.
Could I add a
Anything else?
number 4 to the proposals list, Mark?
Excuse me?
Could I add a 4th point to the proposals
You
debate up there at the top? Okay.
You skipped this part of the portfolio review. What do you want to do?
Well, I just want to consider maybe a sale of 1 or even 2 shares of Novo.
Really?
Well, I'm trying to be as objective as I possibly can, and I'm trying to keep in mind what's going on with the portfolio as a whole. And I'm getting a little bit antsy when it gets up there at 10%, especially since we have some other things to do. And if you're going to let me, I wanted to add a 5th point too when I read this this proposal.
Oh, man.
I know. I'd like to have a serious debate. Maybe not today, maybe next month. But I'd like to have a serious debate about NICE also.
Yeah, I mentioned that before you returned. I think we definitely need to rake that one over the coals. I mean, the only thing keeping it alive right now is this. You know,
and if we're basing that par on the analyst community, I know there's been quite a few downgrades of this stock in the last month or 6 weeks, with a lot of negative commentary to go along with it.
Well, I do think we need to delve into that and carefully think about.
And I have absolutely no problem at all with the first 3 points, but I would like to maybe work into point 4 and point 5.
Okay.
Maybe either 2 weeks from now, or maybe the next time we have money to spend. Maybe that's the best time to look at those.
Yeah, that would generate about $100 for the portfolio. So we'll definitely keep it in consideration. Here's a quick look at Netflix. Again, if you want to review the complete presentation, I presented it during last month's roundtable, so you can access that either on the Manifest Forum or with the YouTube playback of the last roundtable. It was a horse race. I mean, I just barely won a plurality of the votes, so the audience agreed, but just barely. But I think you see up straight and parallel. Here's the major feature. With all the stuff going on with the acquisition, the stock price is down fairly significantly from where it was a year ago. But we're talking about a 12% company with a fairly steady growth picture, very steady profitability, which leads to a very steady earnings line, and a fairly reasonable PE for a company like this. And this is, I think these guys have kind of matured into one of those companies you just talked about, Ken. You got to go back years to get anywhere near 15% here. And that could go on for a long time. So if you're waiting for it to reach a par of 20%, you might wait quite a while. So the projected return on value reconciles pretty well with the projected return, which would suggest that the PE is in pretty good shape. So I think we go ahead and add those 4 shares of Netflix.
I'll tell you, Mark, that I've come to my own sort of semi-rule or something that I'm happy about when I do an analysis of a company. And I've come to really enjoy it when the proof is just a little bit higher than the par. I think that's it makes me feel that I'm on the right side of the conservative aggressive debate, you know, when it happens like that.
Absolutely. I would agree with that.
Another angle maybe to touch on with Netflix, but we don't need to dive in it now. I know in the backup slides we've talked before about the S curve, the business, the life cycle of a business or product. But Netflix is an interesting example, demonstrating its compound growth, not in just doing one thing continuously well, but in reinventing itself. And so regardless of what happens with Warner, Netflix is expressing a desire to reinvent itself in some way, with this deal or with another deal or some other way. So this is the kind of company that pays attention at that point where you're at the beginning of what could be another large growth curve.
Yeah, and in fact, I'd forgotten to mention it, but once again, it was demonstrated this past weekend. They flawlessly delivered on 2 NFL games on Christmas Day, and Amazon didn't do that with their single game a couple nights ago. I don't know about many of you out there in the country, but it was buffering and stopping and dropping out, and so Amazon didn't do it as well as Netflix did. And
Netflix got a lot of thumbs in the air, thumbs moving up from my family on Christmas Day, I'll tell you. So.
yeah, and I was putting a different finger up for Amazon a few nights ago.
They're number one.
Well, this is one of Ken's favorites. It's in the portfolio. We're just simply rounding it up to one share. This is one of the data center companies. What do you like here, Ken?
What I like about it is that I think the company is finally becoming discovered, and that usually results in a PE expansion. And when you have a smallish company that's becoming discovered and moving into business that didn't even exist 2 years ago, I think that you're looking at something that has some staying power to it, and that's all those things talk about this very easy to describe company. These folks do anything electric for any kind of customer that exists, but they've been a big player in the building of all these data centers all over the country right now, and they have a backlog that's just fantastic as far as booked business into the future.
Good stuff. Up straight and parallel. At least they are now. And then this one was not on my radar screen, but Ken put it there. I think it also fits the description of companies that don't reach an elevated return forecast very often, but they seem to be doing a lot of things right, and definitely up straight and parallel. What else do you like?
Well, I think that anybody that's considering Adobe should go to the Morningstar site and read the couple of paragraphs in the analysis about their moat. I think you get all kinds of reasons why Adobe is attractive when you read the reasons that Morningstar gives for giving this company a very wide moat. It's a quick read, it's an easy read, and it's in simple English that makes a lot of sense. I think maybe Adobe has been caught in this web of they're all coming to get me at once, and we're going to disappear. People in this market tend to exaggerate trends and think they're going to happen tomorrow. Witness the argument right now about Venezuelan oil. You know, it's going to disrupt the oil market. It's going to happen next week. That's kind of a specious argument to make about what's happening there with the oil and how we can deal with it. And I think a lot of the criticism of Adobe about why it's not going to be as good a company next week as it is this week is of the same vein. Read it, read everything that you can about Adobe, and I think you'll come to the conclusion that one of the biggest things it has going for it are switching costs. It is the only player, and it's the creator of the way that we transmit documents back and forth on the internet and in real time. And to switch to a competitor is going to play havoc with a lot of major companies, and they won't do it, period.
Yeah, one of the things I like about if I'm presenting to my investment club, these guys very quickly summarize some very key information, 9 or 10% growth going forward, operating margins improving and in the 46 range, and here they give you a PE ratio. And a lot of times you have to really dig to get that type of stuff, so you can see here that these numbers check pretty closely with those type of numbers. Actually, this one down here is the profitability one. So you basically have some validation from a qualified opinion. It's one opinion, but it's a pretty good thing. So I come back to pointing out that this is a very established company that's probably not going to have a PAR of 20% anytime soon, and that we might want to consider taking advantage of something in the teens.
Yeah, I would. We're getting some comments from our audience about Adobe's had a rough last 4 or 5 years, but you know, if this were a company trading at a PE of 50, I would probably not even be talking about it, but it's trading at a PE, an estimated average PE going forward of under 20. And I think that we can afford to take a shot at a well-respected, wide-moat company whose products are protected by an awful lot of patents, and who is the creator and major player in document creation and transmission and sharing. So I don't see any problem in we can watch it. We watch all the stocks in our portfolio. We are not going to buy and forget any of the stocks in the Buttonwood portfolio.
And we could be wrong.
I would add, so in 5 years, Adobe may not have had a positive return, lost half a decade, but we looked at this for the roundtable in the fall of 2022 when it had made a bid to buy out Figma before it went public. And I hold shares personally from that time too. I, even being down from its extraordinary highs, which I was really happy from, I'm definitely positive and happy where we are and see an opportunity. And if you are going to look at this, understand it is not just, so Canva and Figma are competitors to the digital media portion, what Adobe is historically known for. Do not forget to also look into the digital experience, which is about online advertising and traffic tracing. That also is under threat from AI. You'll see companies like the Trade Desk and other things being threatened, but that is more than a quarter of their revenue. So there are two separate business lines to think about if you think that they've got nothing going.
Good stuff. All right, so here's what the portfolio will look like after we do those transactions. Ken, I think we can table yours and come back to them.
I fully expected to, Mark. I didn't expect us to try to do all that movement in one fell swoop. And this leaves our cash at a negligible amount, which I feel comfortable with. And this is a good portfolio going forward, even if we don't sell anything. I just want us to continually watch that percent of total column. I think that's important. I want us to continually watch the growth column. And right now, you know, we're only one company on the list that's not projected to grow at double digits annually. So that makes me feel real happy. I also want us to watch the par column, because even the best of companies sometimes have to be sold when the par gets down to places that skews the gross par number, the portfolio par number, that skews it too low. And as long as that par number is up around, you know, sometime, I'd love it to be in the sweet spot, and it is right now. And as long as we can keep it there or very close to the sweet spot and keep that growth number up to 12 and a half, I wouldn't be sad if we could get it to 13. I think we're looking at a portfolio that stands a good shot of making us at least a 12, 13, 14% return over the next 5 years.
Well, in that case, your mission for next month is to come back with the next Credo technology for this portfolio.
Got to find one like that again, huh? Okay.
There you go. All right,
Mark, I neglected to ask or to even talk about cash, which I still believe is a wonderful financial stock, but I do think that we have enough financial stocks sitting in this portfolio right now. And if you know, if it comes to a point where at some point we want to add a kind of an interesting bank like cash, and that's boy, I keep thinking of it by its ticker, and Pathward Financial. Right, thank you. You know, if it comes to a time when we want to add that to the portfolio, then I think we have to consider how many financial stocks can we actually afford in a 15 to 20 stock portfolio.
Yeah, we're certainly not out of control here yet.
No, not by any means, right?
All right. Just thought I'd close with a quick reminder. We did cover this right around the turn of the calendar from December into January. Eddie Elfenbein puts out crossingwallstreet.com. You can access a fair amount of free information at the site. And just wanted to point out that he came up with 5 new buys. Many of those are community favorites by all means. and 5 cells. He maintains a portfolio of 25 companies, much like a groundhog. By the way, he's won the groundhog as a celebrity in the past. But what I find kind of interesting is the companies that he picked to buy might be kind of interesting to scratch our heads over at some point in the future, versus the ones he's selling actually have higher expectations. The one thing that I do notice a little bit is these have lower financial strength and earnings per share stability than these up here. And maybe that's a consideration that he had, going into the coming year. So it's not just the par, and it's the quality obviously comes in there too. So just thought I'd throw that out there as a reminder that he puts out some really good summary stuff. If you're a stock watcher and you have any of those, it's good to check in on Eddie.
I have only one comment that I think that if we were privy to Mr. Elfenbein's analysis and his figuring and all of his numbers, I think he would disagree with the manifest par value for Comfort Systems. We own Comfort Systems in 3 of the clubs that I belong to, and we disagree with the manifest par value for Comfort Systems. We don't think that the analyst community has caught up with the potential of Comfort Systems yet.
Yeah, much like IES, I think that they're just not catching on yet. And I would agree. I think you'll see them modify their expectations, and I would think relatively soon. All right. So with that, here's your quick reminder that we do archive all of these presentations, bull sessions, and roundtables. My presentation on, I didn't update this slide, my presentation on, what company did I just pick?
Netflix.
Netflix was made during the session that's not shown here. So not shown here is bull sessions for December 2025. Find that.
It was actually, and that roundtable for December was actually dated in January.
Yep.
Because the calendar forced us to January. I'm looking at the date right now. January. No, what is it? What do we?
6th or 7th. Yeah.
We moved it to the 6th, right? Roundtable on the 6th. So if you're looking for a date, it's dated January 6th. The December roundtable is.
Okay, and then just real quickly, a reminder that we're going to be down in Houston in March. So, Matt, we're looking forward to seeing you and your posse down there.
Yeah, it's going to be fun. The Houston Board of Directors just had an on-site at that facility, so everybody had eyes on it. It was busy. We were a little worried actually about how many neighbors we'd have because it's busy, and the staff said, well, it's New Year's resolution time. So they have a bit of a surge in January, but it'll be fine by March. So we're happy, and we look forward to seeing you for sure.
Good stuff. And Ken, quick moment on what we're going to be doing. We're going to talk more about this next week, but go ahead.
Yeah, please, folks, hold your portfolios now. I have enough. And I appreciate your enthusiasm, but we don't have unlimited time to run a portfolio review for the Jamboree that we're planning. We'll be talking about 3 classes. The first class will give us a basis for why we believe certain things about portfolio. The second class will get into what those beliefs actually are and how they can be tracked. And then the third session, which is the Jamboree itself, is held on a Saturday. It'll go for at least an hour, hour and a quarter. And if we can keep the interest, it might squeeze out to even an hour and a half. And we'll be actually looking at real portfolios in real time and talking about suggestions. We are not making suggestions on particular stocks to add or delete from a portfolio, but in general terms, we'll talk about how you should be setting short-term and long-term goals for the portfolios that you're involved with.
Good stuff. And back to the monkeys and the goat. It's our picture for the week.
Now, has that been AI'd, or is that a real picture, Mark?
All I can say is I don't know. And I'm not sure the monkeys can be trusted. The media is full of warnings that you're not supposed to try to be friendly with the monkeys.
Well, at least they don't have their hands over their ears, their eyes, and their mouth. So that's one thing, I guess. All right.
All right. So with that, thanks everybody for spending your time with us. We appreciate you. And we'll be back next week with more on the discovery of opportunity and a little more touring of the Manifest Investing website. Anything else, sir?
No, I'm looking forward. I keep looking forward on Manifest because I can't go back to it even sometimes as in a short of space as a half an hour and not find something new. So I'm very happy about that.
All right. Take care out there, everybody. Let us know if you run into any excellent investing ideas, and we'll cover them here. Thank you.